Early retirement made simple. Financial independence, retire early. When it comes to achieving financial independence and being able to retire early, the general rule of thumb is that you will need at least 80% of your income before retirement to continue living the way you are accustomed to living in order to retire early. To retire early, you will also need to achieve financial independence. If your annual income is $80,000, you will need $64,000 to live comfortably in retirement. Whereas, if it is $100,000, you will need $80,000. To generate that level of income during retirement, most people will need a lot of money to live the way they want to live. But it's not going to be easy. After all, life is unpredictable, and you can never know what fate has in store for you. This is where index fund investing comes in, and how it will help you achieve your goal of achieving FIRE. Today, we're going to provide you with information that will help you in your journey to do it. Welcome to Savvy, where we have lots of practical wisdom to share. Hey, don't forget to hit the like button below, subscribe, and hit the notification bell for more advice here on Savvy. Index funds are a form of mutual fund whose assets correspond to or track a particular market index, which is typically composed of equities and bonds. The fund invests all of its components that are included in the index it tracks. Index funds do not attempt to outperform the market or earn above average returns compared to market averages, making it easier to construct a diversified portfolio with solid returns by focusing on the investment style. Instead, these funds attempt to imitate the market by purchasing the stocks of every company featured on an index to replicate the performance of the index as a whole. Since market fluctuations are typically less volatile across an index than individual stocks, they can also assist balance the risk in an investor's portfolio. If you are interested in making an investment for the long term, or if you are contributing a significant amount of money to the account so that it can accumulate, index funds are an excellent option. How do index funds work? An index fund mirrors the performance of a market index. It has a fund manager whose responsibility is to monitor the index being tracked and purchase or sell when the index's portfolio changes. This ensures that the index fund will continue to track the index. This is termed passive management because no research is conducted, which results in reduced fees for the investor compared to mutual funds. When an investor acquires index fund shares, they are not purchasing the full index. That would be prohibitively expensive. Instead, they are purchasing a proportion of all the stocks comprising the index. What are the advantages of investing in index funds? You spend less time conducting stock research. You can instead rely on the fund management to invest in an index that contains the stocks you wish to purchase. You diversify your risk across numerous company stocks. Most indexes consist of dozens or even hundreds of stocks and other investments, and the diversification reduces the likelihood that you will incur significant losses if something negative happens. It facilitates the diversification of investments. You can purchase stock index funds and bond index funds, which cover the two major components of the investment strategies of most people. However, you can also purchase index funds that specialize in specific segments of the financial markets. It is less expensive. Index funds are typically considerably less expensive than alternatives such as actively managed funds, because an index fund management only needs to purchase the stocks or other investments in an index. You don't have to pay them to make their own stock decisions. Lower tax burden. When compared to other types of investments, index funds have relatively low tax implications. For instance, unlike actively managed funds, index funds don't have to constantly buy and sell their holdings, so they don't generate capital gains that can increase your tax liability. Maintaining your investment strategy is easier. By investing in index funds on a monthly basis, you can safely disregard the market's short-term fluctuations and focus on the market's long-term growth. What are some of the most common index funds? U.S. stock indexes. The S&P 500 index is a widely followed barometer for stocks of large U.S.-based corporations. Some investors prefer extended market index funds that help them keep tabs on the remaining 20% of the stock market value that isn't represented by the companies in the S&P 500. In the United States, we have two major stock market indexes: the Russell 1000, which follows the 1,000 largest stocks, and the FT Wilshire 5000, which includes virtually all publicly traded companies. International stock indexes. Investors have access to a wide variety of index funds that monitor equity prices in both developed and emerging markets located all over the world, allowing them the opportunity to potentially benefit from growth in other regions of the world. In addition, there is a category of funds known as complete international index funds that concentrate on anything located outside of the United States. Bond indexes. You have the option of investing in broad-based stock index funds, as well as a variety of bond index funds. Some examples of the types of bond index funds available to you are as follows: short-term bonds with maturity dates in the near future, long-term bonds with maturities longer than 10 years, emerging market government bonds, and other options. Dividend indexes. Some fund managers construct and monitor their own proprietary indexes, which may include indexes of dividend stocks. The only stocks that are included in dividend indexes are those that make a dividend payment, and the use of exchange-traded funds is a popular method for investors to gain access to diversified portfolios of dividend-paying companies. Index funds are a smart option for investors who prefer to take a hands-off approach to their portfolio management and are searching for a long-term investing option. It enables you to spend less time picking stocks and allows you to spread risk over more investments. An investment in index funds does not prevent you from embracing opportunities presented by certain firms in which you have strong faith. Investing consistently in index funds is a recommended practice, and it's a decent rule of thumb. This will, of course of time, give you returns that are comparatively greater than average without exposing you to the risk of losing all of your hard-earned money. You should never understate the power that comes from compounding. That's enough practical wisdom for today. Don't forget to give us a thumbs up below. We will be posting 4 to 5 videos per week, so click the subscribe button and the notification bell to be notified of our new videos weekly. Thanks for tuning in! See you in the next video.